Where should you keep your emergency fund? In a giant pile of cash and self-storage, obviously. No, so really, if you're not Walter White, you have a couple other options. Hey, my name is Christian, and here we talk about all things money, which today is where to store an emergency fund. We'll cover how to balance between liquidity, risk, and interest, many of the different options available for doing that, as well as what I personally do with my own emergency fund. So in general, what you're looking for here is the highest interest option while keeping your money safe and liquid enough. What exactly is liquid enough? Well, that's something only you can decide for yourself. For most people, the point of having an emergency fund is so that when an emergency does eventually happen, you don't have to take on high interest debt to deal with it. It kind of creates a safety buffer of cash for you. If you can't get to the money pretty quickly, that basically defeats the whole point of having an emergency fund. So an emergency fund of, say, real estate properties or collectibles might not be the best idea. You want it to be very liquid, which is just a fancy finance word for how easy it is to convert something into cash. It also defeats the whole purpose if when you need it, the money's not there, or you have to take a huge financial hit to get it. So you want to keep your risk extremely low with emergency fund money. So probably think twice about crypto or NFTs for emergency funds. Then when you have both of those things figured out, you're basically on a quest to find out who's offering the most interest. How much money can I earn? This is a fun one because companies are literally competing with each other for your business. First up is the most liquid form of all, which is simply cash. For example, sitting in your checking account. You have access to your money at any time, but because it's in cash, you're not earning any interest. This means you're actually losing purchasing power because of inflation. Another downside is because it's so close and easily accessible, there's a huge temptation to use it for non-emergencies. It took me a long time to learn that really the vast majority of success in personal finance is basically good habits, and leaving all of your emergency fund in cash sounds like asking for trouble to me. A related approach is having it in physical cash, actual dollar bills. In that case, you'd also have physical risks like fire or theft. You could even buy prepaid cards if you really wanted to, although sometimes there are fees with those. But then you still have all those physical risks. I mean, technically you could buy a safe, but personally I think there are better options. Now, your bank or credit union probably offers a savings account, and if you keep it there, it's still very liquid. There was something called Regulation D, which was a federal law that regulated how banks and credit unions manage savings deposits. It used to limit the amount of certain types of withdrawals from savings accounts to 6 per month, and although it's been suspended, some banks and credit unions still enforce the 6 per month limit. But, I mean, if you're using your emergency fund for actual emergencies, the idea is you probably don't need to withdraw that money more than a handful of times per month. So in this case, maybe there's a silver lining that some banks and credit unions still enforce that 6 per month limit. It can nudge you a little bit towards a better habit. With traditional savings accounts, you can't write checks, but sometimes there'll be ATM access, depending on the bank or credit union. Usually that's in addition to other electronic methods like ACH or wire transfer. Do be aware though with these electronic transfer methods that it can often take a day or more to clear, especially if it's between different banks. When your emergency fund is deposited in a savings account at a bank or credit union, usually that means that the money is insured by the FDIC for banks or NCUA for credit unions, up to $250,000. So the risk with these accounts is generally considered to be very low. Interest rates are where things get a little problematic with traditional savings accounts. They're pretty low. According to Bankrate at the time of recording, the national average yield for savings accounts is only 0.23% APY, which is something, I guess, but it's really not much. Which then leads us to what I think is a better option: high-yield savings accounts. The liquidity here is pretty similar to savings accounts, with the main difference being that the high-yield variety is usually offered by online banks and credit unions. In general, they can pay more in interest because they have less overhead than their physical cousins who have to pay for all those branches and staff. One trade-off, though, is because of that online-only footprint, online is sometimes the only way to access the money. High-yield savings accounts are usually still insured the same way traditional savings accounts are, and the interest we're talking about here can be a big jump up. Current competitive rates are in the 3 to 4% range, or even higher, like this roundup from NerdWallet shows. Some of the best rates I could currently find include this 4.25% APR from Basque Bank. Staying with banks and credit unions, another great option for storing an emergency fund is a money market account. These are sort of a mix between a checking and a savings account and are usually still FDIC or NCUA insured. Depending on the bank or credit union, they might come with ATM access and/or check writing, as well as those same limited monthly transactions that savings accounts sometimes have. Money market account interest is usually pretty close to high-yield savings account interest. Some of the best rates I could currently find include 3.56% from First Internet Bank and 4.30% from VioBank. For all of these account types, you do have to watch out for minimums or maximums to get a specific APR rate. So make sure to actually read the fine print here, it really does matter. Also, with the account types so far, we're usually talking about variable APR rates, which means that the rate could change. That's why sometimes the offers to get a particular APR will be time sensitive. Which brings us to CDs, because the APR is guaranteed for CDs. However, personally, I don't like using CDs for emergency funds because when you purchase a CD, your money is locked up. It's illiquid until the CD matures. I mean, you could technically get to the money, but that generally means penalties or giving up some portion of the interest. Sometimes there are no penalty CDs that allow getting to the money before maturity, but the interest rate is usually lower. On the plus side, CDs are usually FDIC or NCUA insured, and the interest rates are pretty competitive, currently up to about 5% or so. You could also put your money to work purchasing treasuries, corporate bonds, or similar securities. Again, I personally dislike this approach for an emergency fund because in all of these, getting your money out quickly usually means penalties and/or giving up some portion of the interest. Most experts will advise against putting emergency fund money in the stock market. Stock transactions generally don't settle immediately, meaning that if you sell stock, you might not be able to withdraw the cash from that sale immediately. Also, the risk in the stock market is far greater than many of the other options. You definitely don't want to be in the situation where you're forced to sell your stock position at a giant loss simply because you need the cash right away. Also worth mentioning is that there are a lot of exceptions to usual penalties for early withdrawals from various retirement accounts, like 401ks or IRAs for certain situations. But definitely make sure to consult with a tax pro, as that can get rather complicated. Now, I've also seen people make the argument for no emergency fund. So their plan for emergencies is to pay for it all out of cash flow. For me, I think this is way too risky. I'd essentially be gambling that my income cash flow will always be greater than my bills, and also that the time frames would line up correctly so I could pay everything on time. Even doing something like using a credit card for the emergency and then paying off the credit card in full when my cash flow arrives, that's still way too much risk for me. I wouldn't do it. Some people like combining a few of these approaches, perhaps a bit in physical cash, some in a high-yield savings account, and maybe a few CDs of different maturities to create a CD ladder. For me, for an emergency fund, I don't think the trade-off in complexity is worth it. So what do? Personally, I use a money market account at my bank. In fact, I was planning on opening a high-yield savings account at Basque Bank, but then I got a notice from my own bank offering the same rate, so I just stayed there. I hope that was helpful. I know learning all about it helped me a bunch. Make sure to like, comment, subscribe, share it with a friend, all that good stuff. Have a wonderful day, and I will see you in the next one. Bye!